Our wealth strategy session today, I am super excited, is building the money machine. How to design a cash flow framework that converts income into wealth. You know, I have a lot of great ideas. It's hard to put it to paper. Reed is so good at taking his ideas and putting it to paper and making things digestible, understandable. So we appreciate that for him. Reed, how are you doing today?
I'm good. I'm good. Yeah, I spent a little time working on this, and I've seen you've done such a good job with different illustrating different complex topics with like visuals. And I'm like, ooh, I want to do what Josh does for this specific topic. So I always appreciate how you kind of build out those frameworks and models that are in one screen, one snapshot. You can kind of conceptualize it. I even think about this like for my wife, right? Like if I was gonna die and she
Yep.
had to basically take over all that we're building, which is somewhat complex. Like, how can I give her some educational content or a simple screenshot that illustrates kind of the big picture stuff? So yeah,
That's
that's
on my
kind of
to-do list every year to do like the if I die, do this. And every year I get like a page into it and I'm like, I got other stuff to do. I hear you. That's a good thought. Okay, Reed. For our topic, building money, building the money machine, how to design a cash flow framework that converts income into wealth. Who are we trying to help and what problem are we trying to solve?
Yeah, I think it's for anyone who starts to build something significant and then gets a little bit lost in the complexity of it. So you can always start with the end in mind. And so if you know you want to scale 10 dental offices or you want to own a portfolio of, 20 commercial properties, whatever it is, sometimes you don't realize the chaos that that creates in the process of building it. And so, one, maybe you're already in that chaos and you're just like, hey, I just want to kind of organize this and see how it works, and see how I can maybe apply some principles to my situation. Or maybe you're in the process of building it, and so you build it with the intent to fit within this framework.
Love
And
it.
this isn't the end all be all framework. I initially was going to build this and then put it out to our private Facebook group and say, hey guys, give me some feedback. What am I missing? What would you do differently, right? So that I could just get feedback from peers because I'm guaranteed someone else has thought about this and done a better job than I have. But yeah, so that's kind of who we're trying to serve with this.
This is great. We'll go over this workflow today. It'll bring up great concepts. It'll give like a foundational core, right? And then we'll clean it up, make it even more simple in the future. And this is awesome. Where do you want to start?
So I think we should start on the upper left quadrant. So how I kind of thought about this was like upper left quadrant is like your operational business. It doesn't have to be dental offices, but hey, we're dentists, so that's going to apply to us. And then the bottom left quadrant is going to be real estate, which can be its business. Any facets of that you want. If you're a developer, if you're buy and hold, if you're fix and flip, whatever it is, let that be kind of the bottom left quadrant for you. And then I want things to kind of flow towards the personal side. So once we get to the personal side, right, that's where we think of investing. And you might feed back into your real estate or feedback into your practice or feedback into some other investment that you want. But I kind of wanted to frame it that way.
One of my drudgery zones is legal. And I think we'll start with flow of funds, those concepts. I think that's all most important. The way you have this model laid out, it'll be actually really easy to lay out like legal and like the liability shields on top of this as well. So I really like how you built this because I think we'll be able to overlay that in the future. All right, let's get started.
So first, going to the dental offices up here. So I have two practices, and so how we kind of structure things very simple is we have a primary operations account, and then I have like an EFT account. And so if you guys do EFTs in your practice, right? Those what are they called? Electronic fund transfers that a lot of those insurance companies use. The reason I have a separate account for it is oftentimes that's the most common thing. My insurance coordinator, office manager will ask for verification of that. And so I can give them access to this account because I don't care. It's just income. There's no expenses out of it. And so that's just like an operational nuance of running practices and finding that that's like a little thing I don't like. But from there, it flows to the primary operations account, which is where all of the income and expenses are going in and out. This is what I want to keep more private. I don't want my staff seeing this, right? Because it becomes a little bit more apparent what people are getting paid, etc. So that's kind of that privacy account. From there, from primary operations, it flows out when I take distributions. So I have this 150K. These are arbitrary amounts in these accounts, okay? But I'm just putting them in there to give you an idea. So one of my dental practices, maybe I have a threshold if I always want to keep 150K in that account. That's kind of that, reserved emergency fund, whatever you want to call it. My operation reserves are always that. So anything that increases above that is going to flow down, take as a distribution, and get to my personal account. So I think of it as like a minimum or a maximum I want in that bucket, and then as things flow above that, it gets kicked out in distributions to my personal side.
Can I answer something too here, Reed? A common question is like, how much do I have in each of these accounts, right? Like the what you want to just have in there is enough for variance on that business entity, right? You don't want to have to add personal money back in,
Yes.
just whatever accounts for the variance. You want to have a separate personal account, which is like your 6 months of liquidity account, right? Which is like for personal expenses. But then usually I kind of have like a war chest. So if something really went wrong, right? Like I blew out if I'm the primary income earner for that practice and I blew out my arm or my shoulder and I can't practice, right? I have like oh crap, save the day fund, right? And what's nice when you have multiple businesses and multiple real estate properties, you don't need to have no crap one for each. You just need one. And
Mhm.
so when I see people build out their crap ones, they're massive because they just put them like I'm like, do you really have like $1 million just sitting there in a bank account? It's like, look, like
Yeah.
yeah, like have the 150 for each so it accounts for variance so you're not adding cash in, right? And then just keep one fund. That will if there ever was something that'll fix all of them. So I think yeah, great.
Yeah. So that's like that variance fund because you don't
Yep.
get a lot of yield in there, right? Usually in business operation accounts, you don't get a very much yield. And so you only want to have as much in there as you need. And you don't want to be annoyed to have to ever put money back in, as Josh said. So you just have to set an amount that makes sense for you and for your practice.
It's not just getting annoyed to put the money in 100%. The other thing is commingling. You don't want to
Yeah.
commingle your personal or business to business. And like most of us use banks, like local banks, their software is old. Getting to transfer from one bank to the next bank, from business account to business going, it's annoying. It's not easy.
Yes.
And so, yeah.
Yep.
You don't, oh, commingle, what does that mean? It means when you take like two businesses and you share money, or you take personal and you share money.
Personal. Mhm.
What happens is if you ever get sued, the lawsuit could say, well, you're switching money between these two so that your LLC shield isn't real. They could argue that, right? And because they see these transactions going between them. And so what you always want to do, here's a little pearl, is you want to do a contribution of capital, okay, from your personal into a business. Okay, your bookkeeper reports that as a contribution of capital.
Yep.
And if you ever take money out of a business into your personal, you want to call that a distribution. Okay. Or actually, sorry, first you want to call that a return of capital, which is, I'm not a tax professional, but typically tax free. And once you deplete that bookkeeping account for contribution to capital, then it's taxed as a distribution. So that's one piece when it's personal to business. Between two businesses, you never want to transfer money. Okay, because that destroys it creates a crack in your liability shield where they can sue this business, and then even though it's completely unrelated, they can go and sue this other business too, in a lawsuit. So
Yeah. Isn't it called piercing the corporate veil, right? Isn't that
there you
the thing?
go. Yep.
Yeah. It's coming back to me. It's been a long time since I've read some of that tax and legal stuff, but it's coming back to me. Um, okay, so going back to the flow of money here, right? So we were talking about taking distributions out that'll eventually flow to the personal account. The other element here is this practice real estate account. So I own the real estate of my practices. So what I do is I have an automatic ACH for rent that goes from my practice to that real estate account. And then again, I take a distribution and it flows through my personal. I do that again, just not to commingle funds. Some people will take it directly into their personal checking. Again, I want to keep it separate. So it just keeps things cleaner. So I have my practice, two accounts for my practice, one account for the real estate that my practices operate out of.
Little pearl here, Reed. Do you agree that in general, the best amount to charge yourself is the like maximum market rate
Yes.
for that area? Not the middle, not the low, but the maximum. Okay.
Yes.
Good. I agree with that too. Some tidbits for folks. If you ever sell your practice, the EBITDA multiple, called a cap rate for your real estate, is usually going to be higher than your practice one, right? So you want more income in the uh,
The real estate
real estate than you do the
entity.
practice. And you don't want to make something up
Yep.
that's like not reasonable. So you want it like at the top of market though. And then two, right before you sell, to if you ever sell, like do a long-term lease, like 15 years, like super favorable to the building. Because then you're selling the practice, and then you'll be able to not only get a good valuation, then you'll be able to get even better valuation on that building because you have like a super long-term lease that's very favorable to the landlord. Um,
Just think of it simply as every dollar of profit in your practice isn't worth as much as every dollar of profit within the real estate. I mean, that's all tied to the lease. It's just worth a little bit more. So you're getting a little arbitrage. You're spending the dollar either way. So you'd rather have it flow more towards real estate than stay as profit within your practice. So yeah, good tip. Yeah, so I just duplicated this for both practices. I'm looking at maybe adding a third practice. We'll see. But if I do, I'll just use the same copy and paste the framework, right? That's the beauty of it is you just like, oh, I know how to do this. I'm going to do it again, and you just add it to your framework. I didn't know if you were gonna say something there, Josh, but okay. So, I don't want to lay. We can talk about this. I'll talk about the cash flow first, but I have some like depreciation spots highlighted on here. So that's like tax planning. So remember, the IRS does not tax people; it taxes income. And so you want to think of where can you eliminate income along the way using depreciation or business deductions, etc. So we'll ignore that for now, but that kind of shows how you can maybe layer on tax planning on top of this framework as well.
I do think we need to mention this, like depreciation from your practice building will be passive. It'll be treated as passive income. So that depreciation will go against your other passive income streams, like other real estate, unless you elect the grouping election, quote unquote grouping election between the business and the real estate.
Mhm.
That is an exception to the rule, and that will allow you to deduct your depreciation from your practice building against your dental income.
hmm think about this. I always think this is the coolest thing is like if you want to own 10 dental practices, right? Like it'd be really cool if you bought the real estate with every practice that you acquired or added because you could do this grouping election, right? And keep offsetting income with each piece of real estate. And again, when you sell your practice, you could sell all the real estate along with it and get a higher multiple because again, that dollar in the real estate's it's worth more than the dollar in the practice.
It's been well rumored that Workman, just like Ray Kroc, the founder of McDonald's, made most of his money on the real estate, not the McDonald's. Same with Rick Workman at Heartland.
Yeah.
It's been rumored that he's made more money on the real estate than he has on Heartland itself.
Which is crazy. That's crazy. I mean, it makes sense to us, but most people just don't think about that. So, um, okay, so we'll just the money flows to my personal checking account here, but then let's just drop down to the real estate really quick. So what I have is I have called a real estate, I call it my real estate aggregate account. So I do have individual bank accounts for all of our properties, commercial properties. Now this is really annoying and messy, but sometimes banks require it. They want a deposit relationship if you have a loan with them. And so you need to open up a bank account with that corresponding LLC. And so there are reserves in these accounts that correspond to the size of the property and the needs of the property. So there's cash sitting in these accounts. What I do though is I have a real estate aggregate account that when we have distributions above the reserves that I need in those accounts, just like the dental practice, I have them flow to an aggregate account. And then once that gets to a certain threshold, I have it flow back to my personal. So it's an easy way for me to kind of track distributions and make sure I
Is
know.
your real estate aggregate account attached to a holding company?
Yes. Well, it's fault. So my entity, Faldet Capital, is my and my wife's uh company that invests in the ownership stake in these other. these other properties.
So you have an LLC for each property in the
Correct.
state that that property's in.
Yep.
And then you have Faldet Capital LLC, which is a holding company. Which state is Faldet Capital?
It's in Iowa.
It's in Iowa. Okay. So it's basically a holding company. The advantage to that is it adds like another layer of protection in potential lawsuits, right? Um, so this is a good flow. And the one thing I see people do sometimes once they get wealthy enough is above the holding company, they'll put a trust to like their wife or their kids, an irrevocable trust.
Mhm.
So like at the end of the day, you like even if there is a lawsuit, right? Now you're in the trust. So like someone sees this, an attorney sees this structure, they follow it, and they're like, man, that's gonna be a lot of work to try to get a dollar, right? And like certain states like Wyoming have like charging order protection at the holdco. So usually I recommend like Wyoming or no,
Is it Delaware, the other one? Is it?
no, they're kind of ever since the Elon Musk thing, they're kind of busted. They've shown that they'd rather not protect people. So Wyoming or Nevada are the two
Yep.
that I see most. And then the trust, yeah, that's even more. And then there's way we can talk more about that another time. But I
So,
wanted to bring
so, so the other reason this helps me a little bit is like, so say I have a hold, and maybe Josh will. So this is the nice thing about doing this. This is like kind of getting, financially naked, so to speak, or
Oh
structure.
yeah, this
Like
is amazing.
you kind of expose yourself, and so Josh can actually look at this and be like, "Hey, have you thought about this?" Right? Because
Yep.
if I don't show this all to Josh of like, "Hey, this is roughly what our structure is," I can't get any feedback, right? Like this lays it all out there, makes it fairly clear so that I can get feedback along the way. But one of the things I do is the reason I have this real estate holding company in this aggregate account is because say I hire an assistant or something like that. It's really annoying to hire individuals for these individual LLCs. You almost need this holding company and then have you can hire employees underneath it if you need to help support the management of these assets. So that's another reason. It's an operational thing as well as an asset protection thing. I
No
mean,
employees, only 1099s.
or 1099s, excuse me. Yes, they are 1099s,
Personal
independent
opinion.
contractors.
Personal opinion.
No, but that's true. I misspoke. It's not an employee, but independent contractor that helps me, right?
And
1099.
the reason is liability, right? Like people give HR lawsuits all the time. And then you're paying taxes, right? All those taxes on those
Yes.
employees. But then three, we were talking about this week, is once you kind of get things going and you finally exit dental at some point in your life, you're gonna probably want to create like a solo 401k, and you need an entity to do that that has income. And so, where's your income post dental, right? And so you want to have kind of that entity ready to pivot to that solo 401k. But we can get more into that. This is
Yeah,
great.
Josh made a post about that. I'm like, I can't do it. We have 401ks within our offices right now, and
Yeah.
it
Solo
doesn't make
401k is
sense.
only for when you are less than 80% owner in any entity that has an employee, right?
Yes.
And I'd dive even deeper into that on making sure that that's accurate. That is my understanding, but really dive deep on that. So,
Okay. Okay, so now we know how money is getting out of our dental office, business operations, how it's getting out of the real estate, and then it's how it's flowing to personal. And so this personal checking account is kind of my hub because it's the easiest way that I move money in and out. Like it just connects to everything else for the most part. And so that's where I go if I need to wire money or, kick money up to this high yield account or invest. And so a lot of my automations come out of this hub. And so nothing goes really back this way towards the real estate or to the practice. It is just kind of the end place, and then I distribute it from there. So as the hub, so I have like a minimum amount I want to keep in there. I just said 100K, but again, just arbitrary amount of money. Don't assume I have 100K in this account. But what I do like to have is this personal high yield savings account to get a little bit higher yield. This is when Josh was talking about like a war chest, right? This is technically more of my war chest up here. So anything above my minimum threshold here, I kick up to here and I let it sit in my war chest until I need it and I pull it back and then distribute out, right? So But what I have here also is automations into different investments. So I do the after-tax brokerage account, like where I invest in index funds. I have an HSA, I have some 529s for my kids, and I have Roths for my wife and I. And so these are all automated. I don't even think about it, right? Those are set it, forget it in the brokerage accounts that I prefer to use. Where I am a little more hands-on is right new acquisitions for real estate. This is more of the active stuff. So acquiring new real estate, again, it flows into the rest of my portfolio, which flows to my holding company, and right, and the cycle continues. Um, One thing I put on here, and I don't do this a lot, and Josh and I are talking about this more, but um, there is this ability to invest, to offset active income. So I have that over here outside of business where there's like the SDR loophole, right? If I'm buying short-term rentals or large equipment purchases that acquire or that allow for a lot of depreciation that can potentially be used to offset active income. And so I just have these as kind of two little other investment vehicles I could use to help offset some income. And so I just have those off to the side. But yeah, any thoughts there, Josh?
Um, I mean, just looking at this after-tax brokerage, right? So that's what Reed's talking about, having some money in the stock market. It's liquid, it's simple, and if you do it, you want a dollar cost average into index funds, right? That's the model. The HSA, it's like the best like tax advantaged account that there is. You just can't put much in it every year, but it is, and there's rules about it. We can dive into that sometime. Roths. Reed and I are both like eat crap today so you can get rewarded later. So we tend to look towards Roths and we have tax advantaged opportunities now. So we're okay doing Roth instead of like a traditional, right? Where you save on tax and pay it later. And then the 529s, depending on your state, sometimes 529s are good, sometimes they're just okay. They're not really good. So I would typically, depending, unless you're one of the few states that are 529s are really good, I would tend to focus on the Roth first and then maybe the 529 later. There's just more flexibility in what you can do with a Roth than a 529. But the government may change that, right? They're always changing things right now. Um, so no, I love this model, Reed. I think this is a really good like structured flow to help people think about things. I think this is kind of like the vertebrae, the backbone
Mm.
for
Hmm.
dentists, right? And then if we just refer to this with like specific things, we can always like dive deep or add a branch, right?
Yep.
But you add too much to you add what we actually do into this. Like there's so many things, and this is probably 80% of what we do. But if you add the 20, it just turns into like a Jackson Pollock painting, right? It's just like looks
Yes.
like a color bomb went off. So I think this is really good. We talked about legal. I think one question I have for you is one challenge I always come up with. I mentioned this maybe on our last show earlier on this show is, my local banks, it's really hard to transfer money and they don't have like super easy high yield stuff to just throw money in, right? The more the fintech or the modern banks, they're just like, send money, you just click a button, it's like done, right? Wire money, you click a button and it's done. If I got to wire money from one account in my bank to the other, I gotta do submit it, and then I gotta do a phone call and answer it, and then I have to do my phone password, right? And it's just not fun, right? And it's just much easier to use like the modern banks and the modern fintech. But all the people I get loans from, not all. A lot of my loans come from local or regional banks, and they have like the clunky software. And I'm like, hey, I want to do bill pay. And they're like, okay, that's, $50 a month.
Yeah.
I'm like,
It's annoying.
it's
Mhm.
like, what? So how have you utilized local banks and how have you utilized like fintech or more modern banks in this flow?
Yeah, so for the most part, everything besides this is basically fintech here, right? This is
Okay.
my like a Wealthfront or there's certain other ones, there's
Yeah.
Robinhood accounts, but I like Wealthfront for simplicity. So one thing I didn't put in here again because it created complexity But what I actually have is a personal savings account at this bank, right?
Okay.
It's a personal savings account at the bank that has all my practice loans. And what I do is actually I take distributions into that account because it's very easy. I just hit transfer online, and it's in that account. And that I hook up to this personal savings account because I can just move money in and out really fast. So it's I have one more hub in each of these. So I have a hub here that I can go to here. I have a hub here that can go to here, right? And so it doesn't allow me, I don't have to go through all those little transfers because you can have personal, as long as you have a personal account at those banks, you can transfer out of business accounts really easily.
Yeah.
You just have them add it to your online banking thing. And so that's what I do. And then this is like it's really easy for me to transfer money once I figured out how to use this fintech account. I just look at all the other banks listed underneath it, and then I just say pull or deposit, right? Like deposit or credit, and it's pretty simple.
I think our show today is super helpful. I really appreciate you taking the time to have your virtual assistant or your executive assistant build this out. Um, being dentists, we're very detail oriented, so I think anyone who's watching YouTube video right now sees that deprecation is there instead of depreciation. Yes, Reed knows how to spell. His EA
Oh,
built this out.
yep.
Just
Or my assistant.
FYI, or him. He gave her the instructions and she put it together. But I think what this is going to spurn is a bunch of other shows that are going to be really good to talk about, right? As we kind of flush this out. I'm actually excited about it. It just kind of grounds all the information into like an executable visual, and we can kind of dive deeper and like Covey, right? Like sharpen the saw, right? I always think
Yep.
about one of his principles, sharpen the saw. Like here's the saw, and we're gonna go through like week by week, I think, and just sharpen it, right? Sharpen it for each other. Like I'm looking at this and I'm like, I could probably have done better on my streamline flow. I'm thinking about this, right? I'm dealing with it as it pops up, but I could probably streamline my flow better. And I think as we go through this and sharpen our own saws, we'll be able to help people do it with theirs. I think this reminds me of like the Prophet's first book, right? I think they talk about cash flow management and habits, and I think this is fantastic. So thank you for putting this together, Reed.
Oh, yeah. Thank you. I appreciate that. The effort was worth it, right? If it helps anyone else, saves them headache, time. I mean, it's clarity. Like clarity is worth so much. And I always talk about that in our practices and within our partnerships. Like clarity just gives you peace of mind, lets you breathe. And so I hope this will help somebody as they're building their big thing, that it gives them a little bit more clarity.
As complexity gets added, right, which it always does, complexity is the enemy of execution, right?
Yep.
So you can always take whatever complexity is coming into your life, a new investment, a new whatever structure, and you can kind of insert it in here and then bring back simplicity and clarity. So,
Love that. Yes.
all right, make it a great week. That's a wrap.